So there is this very specific kind of daydream that happens in corporate offices pretty much across the country. And it usually hits right around, 2:30 on a Tuesday afternoon.
Oh, yeah. The classic mid-afternoon slump.
Exactly. You're sitting there looking at these massive spreadsheets, the endless email chains, and you just think, I have the operational chops to do this for myself. Like, I could be building my own equity instead of someone else's.
Right, because the appeal of autonomy is just incredibly strong, especially for a seasoned corporate professional.
It really is. But then, the moment you actually start mapping out a ground-up business, sourcing suppliers, building a brand identity from scratch, establishing some sort of logistics network, the reality of that undertaking becomes, well, it becomes really daunting,
It's terrifying. Honestly, you're looking at years of operating in the red just to figure out the basic plumbing of the business, as they say.
which is why we're doing this. So
True.
if you are an aspiring business owner looking to maybe transition out of that corporate grind, or a semi-absentee investor, or even an existing owner looking to expand, this deep dive is specifically for you.
Yeah, because today we are breaking down the architecture of a very specific franchise model.
Right, we are looking at Big O tires. And okay, let's unpack this because we aren't just looking at the tires themselves.
No, definitely not. Analyzing this specific automotive franchise really reveals the blueprint for what makes a business fundamentally recession resistant.
Yeah, we're diving into unit economics, consumer psychology, and the kind of franchise architecture that actually insulates you from market volatility.
Exactly. So, to really understand the financial potential here, we first have to understand the foundation, right? The competitive moat of the brand.
Right, because Big O Tires, I mean, they were founded way back in 1962, and they've been franchising since 1982, I believe.
Yeah, 1982. But, age alone isn't a moat. It's the corporate engine behind the brand that really warrants our attention here.
Oh, you're talking about TBC Corporation.
Exactly. They are backed by TBC Corporation, which is literally one of North America's largest marketers of automotive products and services. And their whole positioning is being the team you trust, right? Those local neighborhood tire and auto service centers.
But I mean, let me jump in here because the automotive space feels just incredibly crowded. Like it feels
Yeah.
like there's a local mechanic or a big box store on every single corner.
Oh, it is. It's very competitive.
Right. So how does a franchise actually compete in that environment? It kind of feels like a local indie coffee shop trying to secure the same raw bean prices as, a global giant.
Well, what's fascinating here is the concept of purchasing power. And this is the entire thesis of the investment, really.
How so?
Because Big O is integrated with TBC Corporation, franchisees get that neighborhood feel of a local business, but they have the supply chain muscle and the pricing power of a massive multinational corporation.
Ah, so they aren't buying inventory like a mom and pop shop.
Exactly. An independent operator buys inventory, by the pallet or maybe the drum. TBC Corporation negotiates on a global scale.
Wow, okay.
Yeah, they're moving millions of units, which means they secure preferential pricing, priority shipping, and guaranteed allocations from the manufacturers.
Okay, but let me play devil's advocate for a second. Even with that purchasing power, if that independent mechanic down the street is charging the consumer the exact same price for an oil change or, a set of tires as the Big O franchisee, how is the franchisee coming out ahead?
That's a great question. The advantage actually materializes on the buy side, not necessarily the sell side.
Oh, I see.
Right. If the retail price to the consumer is identical across the street, the operator who acquired the raw materials, the synthetic oil, the brake pads, the tires, at a structurally lower cost, well, they capture a much wider profit margin.
That makes total sense. And I imagine during supply chain crunches, that matters even more.
Oh, absolutely. Purchasing power isn't just about price. It's about inventory resilience. I mean, think about a scenario where global logistics are strained, right? Raw rubber or microchips are facing shortages.
Which we've definitely seen recently.
Exactly. Manufacturers always prioritize their highest volume buyers. So TBC Corporation's sheer scale ensures that their franchise network gets the inventory routed to them first.
So while an independent guy might have to turn away like a $1,200 ticket because he just can't source a specific tire size, the franchise operator has the product sitting right there in the bay.
Exactly. It's a huge advantage. You get that local team you trust vibe, but with serious corporate armor protecting your supply lines.
That is a massive insulation against shocks. Which I guess brings us to the actual day-to-day cash flow, the unit economics.
Yes, let's get into that because the brand name is literally Big O Tires. But when you look at the revenue architecture, it is a highly diversified model.
Right, they do a lot more than just sell tires.
Oh, yeah. Scheduled maintenance, oil changes, wheel alignments, batteries, brake repair, suspension services. It's a full suite.
But doesn't that, I mean, does offering oil changes, batteries, and brakes dilute that core identity of being a tire place?
Actually, no. That diversification is exactly what makes the business model recession resistant.
How so?
Well, think about the psychology of buying tires. It's what we call a grudge purchase.
A grudge purchase, like nobody wants to buy them.
Right. It's a high-ticket, low-frequency event. Consumers generally do not browse for tires recreationally.
Yeah, I definitely don't. I only buy them when my mechanic tells me I'm going to slide off the road if I don't.
Exactly. Or you have a blowout. And if a business model relies strictly on an event that happens maybe every 3 to 4 years per consumer, the owner is constantly fighting to acquire new customers just to survive.
And customer acquisition costs are just so expensive right now. It eats right into the bottom line.
Exactly. So by offering those low-ticket, high-frequency services like routine oil changes, fluid checks, the franchise fundamentally changes the relationship with the consumer.
So it's basically a funnel.
It is a funnel. The consumer comes in twice a year for an inexpensive service. The staff builds rapport, they demonstrate competence, they build trust.
I see. So then 3 years down the line, when that customer hits a massive pothole and suddenly needs a $1,200 set of all-terrain tires, they aren't searching the internet for the cheapest vendor.
Nope. They're driving straight back to the facility they already trust and visit twice a year anyway. You capture the high-margin ticket by securing the routine maintenance.
That is really smart. And I noticed in the materials that they also have this ProTech Plus warranty.
Yes, the ProTech Plus warranty. This is an industry-leading protection plan, and it's an incredible customer retention tool.
How does it work compared to like a local shop's warranty?
Well, a local single-location mechanic can offer a warranty, but it is entirely geographically limited, right? If you buy tires from an indie shop in, say, Ohio, and then you move to Texas, that warranty is effectively void.
Because you can't drive back to Ohio for a free rotation.
Exactly. But the Big O ProTech Plus warranty is valid at any franchise location nationwide.
Oh, wow. So that creates this closed-loop system for the whole brand.
It really does. The consumer is financially incentivized to stay within that franchise ecosystem no matter where they travel or move. It completely prevents churn.
And what about the financing side of things? Because $1,200 is a big hit to take all at once.
Oh, the financing is crucial. They offer integrations for robust consumer financing, like 6 or 12-month special financing promotions.
Because, yeah, a sudden $1,500 break in tire job can just wreck a household's monthly budget.
Right. And when a service advisor tells a customer they need a critical safety repair, the biggest objection is usually just a lack of immediate liquidity.
They just don't have the cash on hand.
Exactly. So by offering structured financing right there at the desk, the franchise secures the revenue and the consumer gets the safety repair they need without that immediate capital outlay. It removes friction at the point of sale.
Okay, so we've got a really clear picture of the revenue streams and the competitive advantages. But here's where it gets really interesting. Let's talk about the actual investment.
The numbers, yes.
Right, because you aren't just opening the doors for free. So what is the cost of entry, and what exactly does that buy you?
Well, starting off, the initial franchise fee is $35,000.
Okay.
And it's worth noting they do offer a 10% discount on that fee for qualified veterans, which is a nice touch.
That is great. And what about the financial requirements just to get approved?
You need a minimum net worth of $300,000 and at least $100,000 in liquid cash.
Okay, that makes sense to ensure operators are actually capitalized enough to handle the ramp-up phase. But looking at the total investment range, this is the part that stood out to me.
Ah, the spread.
Yeah. It's estimated roughly $378,000 on the low end, all the way up to almost $1.89 million on the high end.
It is a massive gap.
It's like a $1.5 million variance.
Yeah.
Can you explain to the listener why there is such a massive gap there? What dictates whether you spend under $400K or almost $2 million?
It almost entirely comes down to the real estate realities. That high end accounts for building a brand new facility from the ground up, right? Pouring concrete, engineering structural steel.
Oh, okay. So dirt up construction.
Exactly. Whereas the low end of that range is for retrofitting an existing second-generation automotive space. Finding an old building where the service bays were already cut into the concrete.
Which is vastly more capital efficient.
Vastly. But the franchisor doesn't necessarily push you into the most expensive option just to build brand monuments. It's driven by territory mapping. In a mature market, a retrofit is fast and strategic.
But in a new suburban development.
Right. In a booming new suburb, dropping the capital for a ground-up build on a premium corner lot secures decades of high-visibility traffic.
Makes sense. Okay, and then once you're open, what are the ongoing fees?
It's a 10-year renewable agreement, and the ongoing fees are a 5% royalty fee on gross sales and a 5% ad royalty fee.
Okay, I want to scrutinize that ad fee for a second, because surrendering 5% of your top-line revenue, especially locked in for 10 years, is a big commitment for a business owner.
It is.
Why wouldn't an experienced operator just want to keep that capital and manage their own local advertising budget?
Because that fundamentally misunderstands how franchise advertising works.
Yeah.
You really have to think of that 5% ad fee not as a tax, but as a contribution to a massive purchasing cooperative.
The cooperative.
Yeah, like a farmer's co-op. A single independent owner cannot afford to buy a primetime national television spot. But if you pool a percentage of revenue from over 400 locations, suddenly you can hire a top-tier media firm to launch a massive national campaign.
Okay, but does a national commercial really move the needle for a local shop?
It's not just commercials. This pooled capital actually unlocks manufacturer subsidies that a solo operator could never touch.
Oh, really? How does that work?
Okay, so when Big O runs a promotion, say, offering a $200 instant rebate on a set of big name brand tires, the local franchisee isn't absorbing that $200 discount out of their own margin.
Wait, they aren't? I always assumed the owner took the hit on those sales?
Nope. The corporate entity uses that massive pooled ad fund to negotiate directly with the manufacturers. They project volume. They say, hey, we'll move tens of thousands of units across the whole network this quarter if you subsidize this rebate.
Wow. And the manufacturer agrees because of the sheer scale.
Exactly. So that 5% ad fee pays for heavy-hitting promotions that drive undeniable foot traffic right into your specific bays, funded largely by the manufacturers. You are buying institutional leverage. An independent guy just can't do that.
That totally clarifies the ROI on that fee. It's not just a billboard budget.
Not at all. And your investment also gets you their corporate support structure. Site selection, the comprehensive training, ongoing ops support.
Which brings us perfectly to the growth trajectory and the multi-unit scalability. Because if we look at the footprint, as of 2024, Big O has 463 locations across the U.S., mostly in the West, Midwest, and South.
Right.
But out of those 463 locations, only 2 are company-owned.
Yes.
2?
2 out of 463. That's basically a drop in the bucket. An investor might look at that and ask, does corporate lack skin in the game?
It's a common question, but if we connect this to the bigger picture, that ratio is actually a massive green flag for investors.
Why is that a green flag?
Because it creates a structural alignment of incentives. Think about it. When a franchisor owns, say, 30% of its own footprint, you often see a conflict of interest.
Like they keep the best territories for themselves.
Exactly. They reserve the most lucrative, high-performing markets for their own corporate balance sheet and leave the secondary, marginal markets for the franchisees. They inadvertently become a competitor to their own network.
Oh, wow. I never thought about it like that.
Right. But by operating only 2 corporate locations out of nearly 500, the franchisor is in the business of supporting franchisees, not competing with them. Their revenue is inextricably tied to the royalty stream from the independent operators.
So they only win if the franchise wins.
Exactly. Which is why they have a massive corporate support infrastructure. They have roughly 140 employees at HQ.
140 people, just for support.
Yes, you have 140 professionals whose entire mandate is to optimize the supply chain, refine marketing, negotiate those vendor prices, and provide operational troubleshooting.
So for a corporate executive transitioning into ownership, that is the safety net. You don't have to be a master mechanic turning wrenches.
Not at all. You are stepping in as an executive manager. You are deploying a playbook that is backed by a deeply staffed corporate engine.
And I imagine that kind of corporate depth is exactly what makes scaling into multi-unit ownership viable. 100%. Because if you are an investor with a multi-million-dollar vision, You aren't trying to buy a single shop and stand behind a counter writing tickets all day.
Right, you want to build an empire.
You want to open 3, 5, maybe 10 locations across the region. You install competent general managers, and you oversee the whole portfolio from an executive altitude.
And because corporate handles the heavy lifting of the macro logistics and the national advertising, replicating that model across multiple territories is actually a realistic strategy.
Exactly. That is the defining transition from just owning a job to actually owning an asset.
So what does this all mean for you, the listener? I think the big takeaway here is that evaluating a franchise investment requires looking way beneath the hood.
Absolutely.
You have to look past the product, in this case tires, and really look at the unseen architecture of the business. The supplier leverage, the diversified revenue streams that keep the base full, and those corporate support ratios.
Yeah, and I'll leave you with this final thought. When you are evaluating any business opportunity, don't just ask, what am I selling?
Right.
You need to ask, what kind of ecosystem is protecting my margins when the economy fluctuates? You want a supply chain that guarantees inventory and a corporate partner whose balance sheet completely depends on your operational success.
You're evaluating the fortress built around the cash flow. That is the fundamental difference between building from scratch and stepping into a mature franchise.
Perfectly said.
Thank you so much for joining us for this deep dive.
It was a pleasure.
Keep scrutinizing the mechanics behind these business models, and we will catch you on the next one.